Now we'll move to the last part of capital gains. This part of the capital gains, except for the first part which is going to 50C, so generally doesn't come in the examination, but however you can still listen to it. It's going to be a 15 minutes max, so that will definitely help you in going to the examination in a much better frame of mind, because you know that in the last 2-3 exams, so you're always getting something which you don't expect. So that's how you should go for any professional exam. So we'll now focus first on the most important section, which is 50C. So 50C is basically applicable for a land or a building. So where the full value of consideration will be either the stamp valuation or actual consideration, whichever is higher. If the HSC is of the view that the stamp valuation does not reflect the market value, you can dispute the valuation before the AO. So then the AO has to make a reference to the valuation officer, that the value determined by the valuation officer, stamp valuation, whichever is less, will enter that bucket. So that's about 50C. Very, very important section for capital gains arising on land or building or both. So moving on, the other charging sections, we already discussed about 45 was the general charging section. So other charging sections are 45(1), which is basically applicable for insurance compensation. So if insurance compensation received, then the same will be chargeable tax. The insurance compensation minus the cost of the asset will be taxable under capital gains in the year in which you receive the compensation. 45(2) deals with conversion of capital asset into stock in trade. So if a capital asset is converted to stock in trade, the fair market value, the date of conversion will be deemed full value of consideration. So the FMV minus cost will be capital gains. So final sale minus FMV also becomes business income. So a couple of interesting points which you know to notice: one, the capital gains will be taxable only in the year in which stock in trade is transferred. For 54EZ, you can take 6 months from the date of sale of stock in trade, and it's not going to be taken from the date of transfer. So another important point which you know to do is indexation should be done only after the date of conversion. So and for short term, long term also you should take only up to the date of conversion. So these are some of the very important points which you need to take into account. 45(3) will apply when the partner brings a capital assets, either as a capital contribution or otherwise. So what needs to be noted here, the amount recorded in the books is going to be taken the full value of consideration minus the cost will be taken as your capital gains. So 45(4) will apply when there is a dissolution, then capital assets are distributed partner dissolution, fair market value on the date of dissolution, lies the cost will be taken as capital gains for the firm. 45(5) will apply for compulsory acquisition. The capital gains will have to be bifurcated as capital gains on the initial compensation, capital gains on enhanced compensation. So capital gains on initial compensation will be calculated on the basis of the entire initial compensation when it is first received minus cost or index will be the capital gains. Additional compensation taxable as and when you receive. The cost of acquisition and cost of improvement for enhanced compensation will obviously be taken as zero because you already adjusted full cost against the initial compensation. Again, the indexation should be done only up to the date of acquisition by the government. Enhanced compensation becomes short term or long term based on the holding period. Since the cost has already been considered for initial compensation, acquisition cost and improvement cost will become nil for enhanced compensation. Due to death or for any other reason, if enhanced compensation received by some other person, the recipient will be chargeable tax in respect of the enhanced compensation, even though you may not be part of the transaction. So those are about 45(5). Then buyback of equity shares becomes taxed under 46A, where the buyback price minus cost will become your capital gains. Now section 47 deals with certain transactions which are not required transfer. You can watch out a couple of transactions like gift, will, etc., so which you can go through. So generally it might come more as a theory question rather than as a separate section. So 49(2), which we already discussed, time of cost of acquisition itself. So exemptions we already discussed. So apart from it, 50B is lump sale which came on in the last examination, therefore I don't consider that to be that important for this particular examination. So so I think if you concentrate on these areas in capital gains, I feel that should be sufficient for you. All the very best. We'll move on to the next topic in our next slide or next week.